Welcome to the next installment in our lecture series for American Economic History here at Rutgers University on the Camden campus. This is the online American Economic History course. And as you can see in front of you, in this lecture we're going to be discussing the Great Depression. And obviously it's important to discuss this. And what I want you to realize about this section is I want you to, number one, understand the scope of the Great Depression, how drastically unemployment was affected, how drastically GDP was affected, all right, how inflation was drastically affected. So I want you to realize this because oftentimes the Great Depression is used as a benchmark against other economic downturns. And you will see, for example, in the most recent recession in the United States, they oftentimes bandied about the Great Depression. And I want you to realize how unemployment was increased, or how employment was affected in the Great Depression relative to the most recent downturn in the United States. For example, during the Great Depression, unemployment at its peak reached somewhere in the neighborhood of 23 to 25%. All right, compared to 10, 11% in the most recent recession. So you can see the scope of that was almost double the impact on unemployment. How much did GDP go down, etc.? What happened to the inflation rate? These are all things that I want you to be aware of. And I also want you to be keenly aware of different explanations that economists have ascribed to the Great Depression. All right, there's three distinct views that we're going to take a look at in this particular lecture, and I want you to understand the most important points. Now, I also want you to realize that for something as dramatic as the Great Depression, pointing to a single cause, to me, oversimplifies what occurred. This was a very complex problem that happened in the economy, and not one school of thought is able to adequately explain what occurred in the Great Depression. So I want you to also realize that there are different schools of thought that explain the Great Depression, and they are good at explaining portions of the Great Depression, but they do not or are unable to explain the entirety of the Great Depression. So if I ask anything about the different causes and the different schools of thought that explain that, realize that any explanation as to the causes of it really borrow from these different schools of thought. So make sure you realize that we're going to take a look at, messed that up again. All right, so make sure you understand, number one, the depression data, in particular the unemployment rate, how wages changed, also how inflation changed, and how GDP changed. So I want you to be aware of that, but you don't have to be aware of the exact numbers, but I want you to be, for example, if you know the exact numbers for the unemployment rate, it's probably a good idea to realize that the unemployment rate peaked at roughly 23% during the Great Depression. All right, what happened to people's wages? What happened to production, the value of production in the United States? What happened to prices, interest rates, etc.? All those different types of things are an important component of this particular lecture. What happened to federal finances? In particular, what happened to the deficit, the yearly deficit of the United States during the Great Depression? What did federal finances look prior to the Great Depression, and then during, and then we'll see if that trend continued afterwards. And then, as I said previously, there are three different schools of thought. There are three different explanations as to the causes of the Great Depression. There's the monetarist view that looks specifically at the money supply as a cause of the Great Depression. We have the Keynesian explanation, which looks at decreases in consumption as a contributory factor. And then we have the international view of what happened in the Great Depression. Uh, this looks at particularly our adherence to the gold standard and how our adherence to the gold standard was a cause of the Great Depression. So realize that these are different schools of thought that ascribe an explanation to the causes, but also realize that they explain a portion. None of them really explain the entire picture. And the way I like to look at it is that each of them have a piece of the puzzle, as it were, to the causes of the Great Depression. And if you link them all together and use them as three different causes, you get a much fuller picture as to what happened with the Great Depression. So just to give you a perspective of what happened in the United States and the scope of what happened during the Great Depression. If you look at between 1929 and 1932, manufacturing output fell by 50%. A 50% reduction in manufacturing output in the United States in a 3 to 4 year period. All right, now this is important because remember we talked about previously how the United States was becoming a much more industrialized nation and manufacturing was becoming more and more important to the economy of the United States. It was becoming the most important sector in terms of output, in terms of jobs. So when that manufacturing sector takes that type of a dramatic hit, when manufacturing is that important to the total economy of the United States, that's going to have a devastating effect on the economy as a whole. All right, if manufacturing was a small proportion of GDP, it only comprised 5% of total GDP, this 50% decrease would have had minimal impact. But because of the fact of the technological changes and industrialization that occurred, most of the output in the United States and most people working in the United States were working in the manufacturing sector. So when this sector takes a hit, the economy as a whole takes a hit. Also, take a look at railway passenger car production as just one indicator. All right, 2,200 railway cars, passenger cars were produced in 1929. This fell to 7 in 1932. Now I want you to realize that a portion of this is due to the Great Depression, but a portion of this is also due that railways and rail travel was starting to die out by this period. All right, so this slightly overstates the case here, mostly because of the fact that railway car production was declining to begin with. But to see a decline from 2,200 to 7 in a 3 to 4 year time period really gives you an indication that this industry is being hit very, very hard. And we talked about previously how important the railroad industry was to the United States. So this is also, this steep decline in output gives us an indicator of how serious the situation was. The automobile industry was growing in importance. So we realized that the railway industry was becoming less important, so these numbers here are slightly biased, slightly overstate the impact of the Great Depression on the railway car industry. But when we take a look at automobiles, we see that automobile production fell by 75% during that same 3 to 4 year time period. So these numbers, like I said, you don't have to memorize these numbers, but understand the scope of what occurred in the Great Depression, how dramatic this downturn was in particular sectors of the economy. All right, I'll give you an example of prices. Back then you could get 2 hamburgers for 5 cents. All right, what can you get nowadays? You can't even get a stick of gum for 5 cents nowadays. But back then, 2 hamburgers for 5 cents. All right, not a bad deal. But even at these incredibly low prices, most people couldn't afford to buy 2 hamburgers for 5 cents. All right, average wages, 10 cents an hour. They're talking about raising the federal minimum wage up, I believe, up to $10 an hour, something like that. The prevailing wage was 10 cents an hour. All right. And even at these low wages, people weren't being employed. You can imagine, you would say 10 cents an hour is nothing. Everybody should be employed at 10 cents an hour. People weren't being employed at that low of a rate. Remember, I told you at the peak, the unemployment rate reaches 23% during the Great Depression. It wasn't because wages were incredibly high. We can see wages were low. All right. Any of the banks, and we'll talk a little bit about the banking panics that occurred in the United States where banks were closing en masse in the United States. But the banks that managed to survive had plenty of reserves, plenty of money to lend out to individuals. Interest rates fell below 1%. So banks had plenty of reserves on hand. Interest rates were low, very low, at 1%. Well, you can't say very low, but they were below 1%, but the borrowing did not occur. Even at this low interest rate, people did not think that it was economically viable to borrow at 1% to engage in some economic activity. So even at this low interest rate, economic activity did not occur. I'll give you another indication that agricultural products, some farmers didn't even bother to harvest their crops because prices fell to the point that it didn't make any sense for them to put the time and the effort to harvest the food and send it to market. So agricultural products were actually rotting in the field, and people during this time period were going hungry. Also, just from a sociological perspective, birth and marriage rates decreased during the Depression. People could not afford to get married, and back at that time, there were very few out of wedlock births. With these marriage rates declining, birth rates also declined. So I want you to realize that the huge impact that the Great Depression had on the ordinary citizens of the United States. All right, between 29 and 1930, real GDP fell by 8.6%. Prices fell by 3.4%. Now, some of you are thinking, well, that's good. Prices falling, that's good for me. But realize that when overall price level falls, when you actually have deflation, that's an indicator that the economy is not doing well. That prices are falling, it's an indicator of a recession or a depression. But real GDP, for example, nowadays if GDP falls by 1 or 2%, this is a cause for great concern. So now we're talking about levels that are 4 to 8 times greater than that in a 1-year time period. I also want you to be aware of a downturn that occurred just prior to the Great Depression. In 2021, there was a dramatic decrease. And what I want to show you is, in particular, the decline in 1920-21. And this was after World War I. 1919, end of 1919 was, November of 1919 was the end of World War I. And in the economy of the United States, generally after the end of a war, you end up with a post-war recession. The economy has to recalibrate, get away from wartime production, move away back to peacetime production. It has to reintegrate resources, returning military into the economy, etc. So in general, when we see wartime efforts, we see what they always refer to as a post-war recession, what economists would refer to as the post-war recession. And you can see in 1920, 1921, real GDP fell by an even greater amount than in 1929, 1930, and prices fell even further, 15.2% deflation. The difference was that even though this was a steeper downturn in 1920-21, what occurred was there was a very strong recovery. We actually had what is referred to as the roaring 20s. There was dramatic, sustained increase in GDP and an increase in the quality of life from 21 to 1929. So one of the things we're going to take a look at is why, if this was so severe in 1920-21, it was more severe of a downturn, a 1-year time frame, versus 2930. Why is it that this turned into the Great Depression? This a downturn that wasn't as severe as 1920-21. Why did this become worse? And why did we move further and further in depression? That's so one of the things we want to look at. What was different in the years after 1929-1930 versus 1920 and 21 that caused such a dramatic difference in the outcomes? Also, we can see that if we compare 1929-30 to 1920-21, we can see that in 29 and 30, the money supply fell by 2.5%, and during 1920-21, it fell by more than double than that. So I want you to realize that the downturn in 2021 was much worse than 29-30. The difference is that from 21 to 1929, the economy picked up and there was robust growth. After 29-30, we had a continuation of that downturn, and it got worse and worse and worse, going up until 1932, 1933, until we started to see some type of recovery. Unemployment. At the start of the Great Depression, the unemployment rate was 2.9%. By 1932, the depths of the Great Depression, it had risen to almost 23%. 6% a year increase in the unemployment rate. All right, now if we get to double digits, 10%, people are up in arms with 10%. Imagine an unemployment rate twice that amount and the impact of that on the economy. Realize that from 33 to 37 that the unemployment rate consistently fell and actually got below 10% by 1937. Also, in 38, the unemployment rate starts to increase. And this is one thing I want you to be aware of, that some people refer to 1938 as the recession during the Depression. We see a consistent recovery from 33 to 37, and then from 38 we see a recession in the middle of the Great Depression. We don't reach the levels of real GDP going up until roughly around 1940. So real GDP in 29 was not reached until roughly 1939 or 1940. All right. And then what do we see with the unemployment rate going up into World War I? We can see that it consistently decreases from 11% down to 6% by 1941. So I want you to realize of what happened. Number one, the trend of unemployment, that there was a dramatic increase in unemployment going to 1932. From 33 to 37, unemployment was trending downward. It increased in 38 and then trended downward again going into World War II. So if we could take a look, and here's the actual data that I was actually referring to. So you could see, for example, the unemployment rate. What a dramatic increase from 29 to 30. 2.9% to 8.9%. 30 to 31. 8.9% to 16%. 32, 23%. All right. What do we see in nominal and real GDP? If we take a look at nominal GDP, this is current prices. That's the price in the year. So this is GDP based upon prices in 29. This is GDP based upon prices in 30. This is GDP based upon prices in 1931. What do we end up seeing? Going all the way, nominal GDP decreases from 29 to 33. Then it starts to pick up again, and then we get to 38, and it dips back down again. Same thing for the unemployment rate. See, the unemployment rate consistently falls from 32 to 37, and then 38, it jumps back up again. So we can see that this 1938 period is that period where we talk about that recession within the Great Depression. All right, what do we see about budget? We see that we run a surplus. The federal government runs a surplus in 29 and 30. But after that, it consistently runs a deficit. The first year that they run a surplus, what happens in the year after that? We see that the unemployment rate increases. We see that real and nominal GDP decrease. All right, so some people argue that there was policies that were put in place to deliberately balance the budget, and that if they had run a deficit again this year, we would have not, in the year 1937, we would not have seen the dramatic increase in unemployment and the fall in the value of real output. Some people also argue that the unemployment rates are understated in these figures, and what Stanley Liebergoat calculated was the unemployment rate that included people who were in the federal work relief programs. We talked about, we'll talk a little bit later about the New Deal programs. It's called the alphabet soup programs. There's all these public works projects. I actually had a relative who worked on a public works projects during the Great Depression. If you're familiar with the area, if you're familiar with Morristown and Strawbridge Lake in Morristown, that was a public works project. It started off as a private works project. The Strawbridge family went about building this lake to increase employment, and then it became a Civilian Conservation Corps project, and the relative of mine worked in the Civilian Conservation Corps. Basically, they dug out that area and converted it into a lake. I believe that was originally a tributary of the Pennsauken Creek system. I've looked at maps recently, and it looks like it most likely was part of the Pennsauken Creek originally. So what they did is they built a lake. They dug it out. They built a dam, etc., those different types of things. So what Liebergoat does is he includes those people who have worked on those public works projects as technically being unemployed. They weren't. The only reason they were employed is because they were employed specifically in these work creation projects. And he comes up with slightly higher estimates of the unemployment rate. For example, if you take a look at his numbers are much higher. All right. 24.9% in 33 versus 20.9, 21.7% in 34 versus 16.2. So these numbers are the actual unemployment rates, and this is Liebergoat's adjustment to include individuals who are working in these public works projects. And you can see it basically gives you an impact of what these public works projects were actually doing. They were actually reducing unemployment. For example, in 33, they reduced unemployment by 4%, 5%, 6%, 7% in 1936. So this gives you an estimate of how these public works projects and how much they reduced the unemployment rate. So even if the government involvement in here, basically the government was employing between 4 and 7% of the labor force on these public works projects, and still we had we had historically high levels of unemployment. Real GDP, 8.6% fall from 29 to 30, 6.5% fall in 30 to 31, 13% from 31 to 32, and then from 32 to 33 we see that the fall is only 1.3%. You can see these are incredibly large numbers. If we see unemployment rate dip by 1 or 2%, it is cause for great concern. Economists are worried that we're moving into a recession. Imagine a double-digit decrease in GDP. All right. If we look at 34 to 37, we see that there was almost a 30% increase in that recovery period. So I want you to realize that break point from 29 to 33, or even to 32. And then after that, we start seeing GDP increasing from 34, 35, 36 at 1937. And then again, we have that recession within the Great Depression. 38, we see a dip in real GDP. And just like the employment trends we're talking about, from 39, 30 and 39 and 40, etc., we see steady increases in real GDP from 38 through World War II. So let's take a look at some other indicators of economic activity. Here we're looking at gross private domestic investment. This is total investment. We're taking out capital depreciation and investment that's occurring in the United States. And we can see that we have about $16 billion worth of investment in plant, capital, and machinery in 1929. This falls to 10 billion, 11 billion in 1930, and continues to fall going into 1932. We can see there's a dramatic, I want you to realize that consumption was going down during this time period, but also investment in the capital stock, building new plants, buying new machinery, etc. Dramatic decrease in this domestic investment. And then once we reach 34, we see that this starts to pick up. Gross private domestic investment increases up to 37. And then what do we see again? That recession within the Depression in 38, a dip, and then it starts to increase again. Let's take a look at the number of mergers. The mergers being an indicator of economic activity. 29, 1,300 mergers, falling to 800 in 1930, and then by the time we get to 1934, the number of mergers has decreased to roughly 100. Dramatic decline in the number of mergers, and again, what do we see? It starts to pick up. It's relatively stable in 38, and then once again, we see a drop off, this time in 1939. Patents, number of patents. Another indicator of this is an indicator of innovation that's occurring in the economy. New inventions being created. What do we see? Number of patents declines during the beginning parts of the Great Depression, and it starts to pick up from 34 onward, or 33 onward. New corporate issues of capital, i.e. borrowing. What happens to corporate borrowing? Drops in half from 29 to 30. Drops by a third in 1931. Keeps falling and falling into 1933. I want you to realize these numbers in parentheses. What it means is that these numbers here aren't comparable to the numbers up here. They changed how they created this series in 1934. So comparing this period to this period is not really applicable. There's a dramatic change in how they created these numbers. Let's take a look at stock prices. Average stock prices, 220 by 32, 68. All right, 70% decrease, roughly 75% decrease, 60% decrease, somewhere along those lines. So you can see that the stock market prices are dramatically falling during this time period. And what do we see? They keep picking up in this 36, and then in 37 they start to fall. Again, that recession in the midst of the Great Depression. Personal consumption. What happens to personal consumption? Personal consumption falls. Again, that same pattern from 29 to 33. Personal consumption falls. All right. About 28% from 29 to 33. It picks up in the latter half of the Great Depression, and then again falls where? In 1938, again, that recession in the Great Depression. Interest rates. What do? They fall. Look at these interest rates. Less than 1%. The prime interest rate was roughly 6% in 29. It falls below 1% in 35 and 36, and stays below 1% all the way through up until 1941. Same thing happens with the commercial paper rate, 90-day, the rate to borrow funds for 90 days. So let's take a look at the different explanations that occur for these firms. Number one, not these firms, but the explanation that for what caused the Great Depression. Make sure you realize three different views: the monetarist view, the Keynesian view, and the international view. All right. What Friedman and Schwartz do, and they have a quite lengthy tome, a book about monetary issues in the United States from 1860 up until about 1960. it's not a page turner by any stretch of the imagination. So if you look up Friedman and Schwartz, they have this monetary policy or a book on monetarism in the United States. It is a good book if you want to look at specific periods as to what occurred in the United States. So they concentrate on why a recession, a very severe recession, i.e. a recession that was on the lines of what occurred in 1920 and 21, and how it evolved into a Great Depression. All right. So what they do is they take a look at what happens in the banking system, and they see a decrease in deposits to reserves, and they see a decrease in deposits to currency ratios. What that means is that the public is holding their money in their pocket. They are, instead of leaving money in their checking accounts, they are withdrawing money out of the banks and hold it in the most liquid form that it can be, cash. So people during the Great Depression, we see a decline in the economy. It was exacerbated by the fact that what happened was people started withdrawing funds out of banks. All right. So the money supply started to shrink because as people start taking money out of the banks, that's reserves that the banks don't have. What the banks do with those reserves is they lend them out to other individuals. All right, make sure you realize that number one, that the process where you deposit money, the banks keep a fraction of it on hand and they lend out the remainder of it is actually money creation. The money supply increases by the loan process. So if people are taking their money out of the banks, that decreases the reserves the banks have, which means they have fewer loanable funds available to lend to individuals. All right. So that shrinks investment. So what we see is consumption decreases. This causes people to take their money out of the bank, so the reserves in the banking system decrease, which means they have to cut back on the loans that they're making to individuals. All right, so those individuals can't go out and purchase items, can't purchase or build a new plant or build new machinery, which causes them not to order or go and build something. So construction jobs go down, manufacturing jobs go down. Those people see their incomes going down. We see more and more people pulling reserves out of the banking system. So it's almost a vicious cycle of what occurs. You see further reduction in the money supply, which causes the economic downturn to go down even further, which causes people to pull more money out of the banks, which causes them to restrict their loans even further. All right, we talk about the banking system, and there are the banking panics that occurred in 1930. So make sure that you're aware of that. That 120 banks failed during that time period, and realize that the Fed was pretty limited in what it could do. It could lower the discount rate, or it can engage in open market operations. The discount rate is the rate that the Federal Reserve charges to member banks for loans, and open market operations means that the Fed could engage in buying or selling securities. All right. Also, Friedman and Schwartz emphasized a private bank called the Bank of the United States folded, went out of business. And people interpreted this as an indictment against the general credit of the United States. A lot of people saw the Bank of the United States and thought of the Bank of the United States, that they thought it was officially tied to the government of the United States, and then they heard the Bank of the United States shut down. And this caused people to, in general, lose faith in the banking system as a whole, because they assumed that the Bank of the United States was sponsored by the United States government, which it was not. So this undermined consumer confidence. And then we end up having a second wave of failures in 1931, which further restricted the money supply. The Keynesian view. Keynesians counter, and make sure you realize what's the difference between these and the criticisms they have of one another. The Keynesians criticized the monetarist view by saying that the real money supply was equal in 1930, 31, 32 as it was in 1929, that the money supply just shrank by an equivalent amount of the economy. So it wasn't a cause; it was an effect. That the money supply, that as the economy shrunk, the money supply shrunk along with the economy. And the difference with the Keynesians versus the monetarists is the Keynesians looked at what started the Great Depression, while the monetarists sort of looked at, well, why did this downturn become worse? So, as an overall explanation, if you look at the Keynesian view as an explanation to why the Great Depression started, and then taking a look at the monetarist view as to why this economic downturn got worse, look at the Keynesians for the start, and then look towards the monetarist for why this downturn turned into a Great Depression. All right, and there's research, for example, Peter Temin found that expenditures fell independent from changes in the money supply, that people's personal consumption expenditures were falling faster than the money supply. So they point this as to a dramatic decrease in personal expenditures is what was the initial start to the Great Depression. So we see personal expenditures falling by 9% in 1929-30, 13.5% in 30-31, and 20% in 1931-32. And finally, let's take a look at the international view. The international view emphasizes factors outside of the United States, in particular the gold standard, that our adherence and trying to adhere policies to adhere to the gold standard was a contributory factor towards the length and severity of the Great Depression. All right. So the Fed, realizing that there was a stock market speculation going on and gold was flowing out of the United States, decided that it needed to raise interest rates. By raising interest rates, it would hope that it would decrease stock market speculation, because if it raised interest rates, it increased the cost of borrowing money to speculate in the stock market. And then by increasing interest rates in the United States, people would invest in the United States, and that would cause gold to flow into the United States. Also, the fact that by raising interest rates would put a damper on inflation, which would lower prices, which means we would import less because it would be cheaper to buy domestically produced items, and it would increase exports because our domestically produced items would be cheaper to foreign nations. So that would further improve the balance of trade and encourage gold to flow in the United States. Unfortunately, in the aftermath of World War I, it was not so easy to deflate prices and wages. Workers had been used to the fact that during World War I and the beginning parts of the 1920s, they started to see their real wages increasing through World War I and World War II. So they had built in this expectation that real wages were going to continue to go up. So their expectations ran into the fact that the Fed was trying to deflate prices. And this disconnect here, workers were still attempting to get real wage increases while prices were going down, and that was a contributory factor to the Great Depression. All right, also realize that after World War I, gold stocks in Europe were particularly low. While war had broken out in Europe, many people shipped their gold out of Europe to keep it safe, and where would they ship it? They shipped it to the United States. All right, so one of the things that happened is that when interest rates in the United States was increased by the Fed, other countries felt they were compelled to raise interest rates to protect their gold supply. So the United States instituted policies to increase interest rates in order to protect its gold stock. But what happened is that all the other countries who were on the gold standard felt compelled to raise interest rates along with the United States. So you see the United States raising interest rates, you see Europe increasing interest rates. So the argument here is that this is an international explanation as to why the Great Depression was international in its scope, is the fact that the adherence to the gold standard was causing the nations on the standard to raise interest rates, and this choked off consumption that was occurring. Remember, we talked in the 20s that people were more and more purchasing goods on credit. So as interest rates went up, it became more expensive to buy things on credit. They cut back on their credit buying, which meant they cut back on their buying as a whole. So we see that these interest rates are going up in the United States, which is going to decrease consumer durables, it's going to decrease investment, but it was just not in the United States. This impact of higher interest rates were increasing throughout the world because of the industrialized nations' adherence to the gold standard. So that's what Barry Eichengreen's argument is, that the steps of defending the gold standard transformed that recession into a depression and actually turned it into a global phenomenon. And this is just a table that gives you the value of dutiable imports and how important imports were. Some people argue that the Smoot-Hawley tariff, we were increasing our tariff rates and causing imports to be more expensive. The thing is that as the United States increased their tariff rates and increased the tax on imports, other countries followed suit. You had a tariff war. The United States raises their tariffs, other countries respond. The United States raises their tariffs even more, other countries respond. So another argument on the international side of things is that the Smoot-Hawley tariff contributed to the downturn because it decreased international trade, something that was not as important as it is nowadays, but something that became more and more important over the decades that followed.